Markets continue to produce that consolidation in the short term that we've been anticipating. And the question is, what is it over? Like, have we had enough? I'm going to show you some charts to see whether or not this has been enough. And if it isn't, how much more we can get. And if it is, what that might lead us to, what kind of pattern that might lead us to if this is all the short-term pullback we get. So I'm going to kind of break down some potential moves in the market based on how we've past precedent on different patterns we've seen on a technical basis. I'm also going to talk about what's driving this decline and what one big outlier there's been during these last few days of weakness. One outlier strength, which has not been a strong area in the past. And then we're also going to talk about our trade idea of the day of taking advantage of a pullback in this particular stock and looking for a bounce and taking advantage of the reward or risk potential we have on any potential bounce we get. So let's go ahead and get started. Today is Thursday, November the 21st, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast tool. And you can see, the first 3-day losing streak that we've had all the way since over here, right around September expiration. We were down 1 day going in and 2 days coming out. Here, we were up going in and out, and then down 3 days in a row. But a little bit of a pullback. You notice still it's not even a 23% retracement. And you notice also still that it's not even a 1% pullback. It's still only a 0.6% pullback. To give you some context, that's still nothing, right? That's still not even an exhale in the least bit. So if this is all, I mentioned this today in our portfolio management class, but if this is all that we get, then, and we don't even pull back down to 30.70, which, like I said, is just 23% retracement, then more than likely you'll break up above 31.27. The near-term line will bounce back up above, but not as high as this peak over here where we got to 97 on the near-term line. So we'll most likely form a lower high with a higher high, a slightly higher high, and that would be ripe for a bearish divergence pattern to develop, to where at some point in time you'd have to move this up. So you'd move, wherever you end up getting the high point, you move it up to that high. But then at that point you would expect to drop down to these lows, because that's the divergence target, would be the low in between the two highs. So if that's all we get in terms of new highs, then look for a bearish divergence pattern to come out of that. Otherwise, we're still 30 some odd points above what we could pull down to, and like I said, still just be a 23% retracement. In fact, we could pull down to 3009 and retest these old highs for support, and still be a 50% retracement. We can pull down to 38%, 3037, and form that really bullish pattern I'll show you on our trade idea of the day, where you get a light pink shade. Most likely we get the intermediate line falling below 80, which would give us light pink shading, and a drop below the moving average, because it's already above the 38%, would give us a yellow line. That would be a really bullish pattern, potential bullish pattern there. So we'll kind of keep our eyes on this. I actually wouldn't be surprised if this is it, if we don't bounce up here to new highs in the short term. But also keep in mind, it would be better for us if that ends up being the case, dropping down to 30.72. And then you'll probably chop, I said before, and you'll see that in the Russell 2000 already. You notice the Russell 2000, its most recent peak, first of all, I had a longer than normal near-term run. Second of all, I formed a bearish near-term high, so a lower high with a high on the near-term line between 50 and 80, and is already coming down. So, but on the other hand, you have that bearish near-term high point, but you have a bullish pattern. This is a bullish pattern, dark, strong bullish intermediate posture, oversold momentum line with a near-term line below 50. So this kind of shows, that we're kind of going from really bullish trend, short bullish near-term run here, very short bullish near-term run, longer than normal bearish near-term run, but it never did get below 20, so that's a good bullish sign. and then it bounced up to an even shorter near term, well, actually a little bit longer, about the same length, but not as high, and a lower high forming on the index, and now already this kind of bullish pattern here. So that's choppy. That's the kind of choppiness that you would expect to see on the S&P, and as the longer that we continue to diverge here between the S&P and the Russell, see that little divergence there, the longer we diverge, the more likely we get more of a pullback. And that's really not what we want, right? Nobody's comfortable with these pullbacks. We get markets in turmoil, people thinking recession, nobody buys the dip, and except for the smart, the big money, institutional money. Nobody else buys a dip, and we wait until over here to go bullish again, and that's why the ranges get smaller, because the retail investors are the only ones willing to buy up in this area. So that's kind of where we're at right now. The posture is still strongly bullish. I still expect, like we're seeing on the Russell, some choppiness to occur in the near term. But like I said, we either continue down and continue that choppiness, or we bounce from here to a higher, to a divergent, most likely divergent near-term high, and which basically extends, which would lead to more near-term weakness whenever we do form that. So I do not expect us to form another one of those kind of 3% moves. See, we get the 1.3% pullback. I've compared our current move here to this one, where we had a nice good 7+% rally at 23% retracement, in this case of 1.33%, and then we rallied up 3%. I don't think we're going to rally up 3% off of this, because then now that would extend, because there's no 1% pullback. We won't have a red sticker here. We'll continue to move up. Once we go up to higher highs, we'll move this green line up, and we start to kind of get limited as to how much further we can go up. Because if it does go up to, say, 10, 12, 11%, the last time it got up to 12% was January of 18, and we fell like a rock coming out of that. And the catalyst might be different, but the technical environment would be too extreme in the short term, too euphoric in the short term. Not necessarily euphoric in the long term, because risk appetite is barely turning higher on a whole, but definitely too euphoric in the short term. All right, before we look at some other charts, I remind you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. We have over 5,000 subscribers now to our YouTube channel, so we're really thrilled about that. We're a relatively new channel. We built up quite the following on our old InvestTools YouTube channel, but since that got terminated when InvestTools got taken down, we had to start anew, and we're already back up to 5,000. So we really appreciate it. It's a big milestone for us. So let's start working our way up to 10,000 here. Also, while you're down there, hit the thumbs up icon down below the video. That tells me two things. You liked our video, number one, and number two, you want us to do it again tomorrow. So it's our survey. It's a quick way to see whether or not you like our videos and you want us to keep doing them. If that's the case, click that thumbs up. If you don't want us to do the videos anymore, you can let us know by not clicking down there. And also, while you're down there, comment, what did you get out of the video today? We always are interested in some back and forth with you all. Subscribe to our Market Scholars website. There's a link popping out right there in the top right corner of your screen. It's free to subscribe. You get access to our Market Outlook forum as part of our community on our website, access to our market commentary section of our blog, as well as webinars that we put out there. For more content in addition to these videos, follow me on Twitter. We put out stuff day after day, myself and Brandon, as well as on our Market Scholars account. And then join our Market Outlook Facebook group that we've created for those of you who watch these videos, that we can be able to interact with each other there as well. All right, if you're watching this on our blog, we invite you to kind of check out the rest of the stuff that's on the side. Here's our Market Outlook live videos that we do. Here's our calendar of classes we have coming up, including my technical analysis class. You get access to that, as well as our other 7 8 total trading rooms on a weekly basis with our Plus subscription. If you mouse over here, it's our Plus subscription here. It's the $99 per month. That gets you access also to all the archives. We also invite you to engage with us on social media by liking the Market Outlook tweet right here. Click that like button and liking the Facebook post. That ensures that Twitter and Facebook promotes our content in your timeline so that you always see our stuff when we put it out there. If we take a look at the long-term chart here, you can see, as I mentioned in last Friday's Market Outlook video, you can see how the high now is below the close. So far, the close is below last week's high point. So that's more neutral, right? And that's, again, the pattern I mentioned to you before last June when we had that pullback. This is the pattern, right? So after getting highs closing above the prior weeks, the close being above the prior week's highs multiple weeks in a row like we've had, now we're kind of getting more neutral. And so even the long-term chart is suggesting that we'll get some near-term choppiness here. Most likely not the choppiness that will produce, a bearish move. And it might produce, one little transition candle, but we've seen, a transition candle that can just lead to another leg higher, which is what I would expect in this case if that occurs. Now, if we take a look at the 3 green arrow chart here for the S&P 500, we got the 1 red arrow still. So it had turned red, and now it's back to turned green and it turned back to red. It's going to continue to do this. We've had our surge that starts the intermediate run. Now the MACD will just kind of go up and down a little bit at a time as we trend higher. So it's going to kind of fluctuate like that and not go very high to the upside, not go very high to the downside either. If you take a look at the 2-line versions here. All right, so you can see the pullback on the 2-line versions is basically got us down to the 8-day moving average. So, that's why we're kind of stopping here. We're still closing right around the 8-day as we've been this whole time. A little bit of negative momentum, but look how high the momentum is. It's, it's not easy. There's stages to reversal, and usually there'll be a like this is a divergence. That's what the MACD stands for, moving average convergence divergence. Well, here's our divergence. Usually there's a convergence before you get a pullback. So we're not getting the convergence quite yet, and that convergence usually means that we gradually move lower before we fall to the downside. So we might be starting that pattern, but that pattern can last a month or two, that pattern of convergence. All right, now let's take a look at the intraday chart, and you can see the choppiness here that's forming and a little bit of decline, and we're starting to fill in some volume in this area. At the top, we're still above the point of control. That's at 309, so that's still okay. But if we continue to kind of chop around and then break and form a lot of volume up here and then break 309, then it's going to be hard to get going. That's just going to be how the short-term choppiness that lasts a week or two will develop, because it won't be easy to break back through that ceiling that's right now being built. So again, we might pop back up and diverge a little bit up to new highs the next few days. But the more volume gets built up here and we break the point of control for whatever reason, then we'll we'll go up and down, because there's plenty of support down here. So it's not like we're going to free fall below 309. In fact, you'll probably get some support right around the 307 area. So there's plenty of support there, but it won't be able to go right back up and shoot up to new highs either, because it'll have a lot of volume to work its way through. So keep that in mind as we kind of go sideways here. The longer it takes and the more of the volume that picks up, and we eventually break down for whatever the reason, just in the short term, not a big breakdown, but this is a short-term breakdown, then it will be hard to get going again. And that's the problem when you go up so far so fast and then you chop around for a while. You build that ceiling up there with all this volume that's trading in this particular area. If you look at the total volume today, it was actually a little bit above average. Here, let's go to this chart. You can see the volume just a smidgen above average there, but the range continues to be really small. So the range was 1.62 today. Yesterday it was 2.79, so a little bit above. But look how low the ATR is. The ATR itself is way below 1% now. Down to 2.2 level, and that's generally about as low like we've seen, if I were to kind of extend this out a little bit to give you some context and how low it can go, at 6.82, 0.6892 here. Where is it? That's the one I want to activate. I'll edit that, and it's 0.6892. I don't know why it's not doing it. Let's see if it'll let me do it now. Alright, well, it's close. I don't know why it's not moving. That is strange. But this is about where it's at right here. It's about where it's at. Let's see if I can zoom in. Yeah, we can't really tell. But you can see that's about as low as we got here, and it's about as low as we got on that, basically on our last two intermediate runs. Now, over here in 2018, in the fall, we got below this level and stayed down for a few weeks. And then in 2017, which is one of the most bullish markets we've had in a while, we stayed below this level for almost a whole year. So, but you can see how, that's a pretty decent, we are pretty decently low. It doesn't have to bounce. It just means it might not go very much lower at that point. And remember, if it goes higher, then that's usually coincides with more at least intermediate pullbacks, if not market sentiment pullbacks, which is what that turned into, and what this was here as well, and what these two were. So you can kind of get an idea of how low this can extend. Very, very low volumes as well. The volumes are really low. Remember, 50 million at 310 versus 50 million at 200 is a totally different story. So there is going to be a natural tendency for volume to drop anyway as price goes up higher, because this is more expensive of a share to trade. But if you were just looking at it on the 1 year basis, again, very low compared to the 52-week range. And volumes are going to stay. You want them to stay relatively low if we're going to maintain bullishness. You look at the VIX and you can see we're right in the sweet spot. Still a little oversold on volatility, but not extreme, but right in the sweet spot of the bullish moves. And you can see the kind of jump up. So you see the trend is a little bit higher here, ups and downs, and we're trending higher. Don't be surprised if we don't continue as we get some near-term chop, that we don't trend up to above 14 into 15, maybe even up above 15. That will help expand the range. This volatility is really compressed this month in November, so a move up towards 15 will really help lessen the risks of this volatility compression that you're seeing. It's very, very risky. When the more volatility compresses like this, the more likely you are to get a big move up, like a big open candle, which means we have a whole month where volatility pretty much rallies, and that's those intermediate pullbacks. I don't expect that to happen, but it would be nice if we got some an increase in volatility to help lessen that risk of that occurring. All right, so to summarize our technical outlook, it's a strong bullish posture. We are overbought in the short term still. We are kind of starting to get some pullbacks in some areas, not in others, particularly large caps, but still, expect some more frequent ups and downs in the short term over the next week or two as we get through this holiday by the end of the month. And ideally, we'd want to see some volatility increase over the next couple of weeks to avoid a potential December where we get a significant increase in volatility. The catalyst will most likely be something related to those December tariffs that are expected to either be rolled back as part of a phase one deal or to get implemented if a deal doesn't go through, which, based on past precedent, probably would cause a big increase in volatility there. So we're setting up for an environment where that can happen with the compression we're seeing in November. So what do you think? Do you agree with that assessment? Do you disagree? There's a poll right there popping out top right corner of your screen. Hit that link, opens up the poll. Hit either agree or disagree. If you click disagree, comment in the comment section below on what you're seeing that suggests something different than what we just came up with here with our outlook. And we can kind of keep that conversation going among our market scholars community here. All right, if we take a look at the asset classes, it's interesting to see how bullish the international stocks have been over the past 3 months. Now, keep in mind, You extend that out to 6 months, and you see just how bullish safety trade has been, and the pullback we've had on the safety trade, and a little bit of the bounce that we've had in crude oil. So you can also see there's still more. I mean, over 6 months, you still have a 14% run in gold and 11% run in long-term bonds. So there's still some room for that safety trade to unwind. And you can see the international stocks had been weaker, especially over here. They had been weaker, and now they're rising. Now, small cap stocks was also weak, and it's still been unable to really get going to the upside yet. So the lack of significant moves here, and you can see there's small cap stocks kind of lagging behind the S&P and lagging behind developed markets, and also the lagging behind of crude oil, which is typically a higher beta play. So if we're bullish, that generally is more bullish. Then you can see that we still the risk trade really hasn't taken off yet, and as you saw before, the safety trade really hasn't unwound yet either. So there might be some short-term choppiness, but I would hardly translate that to any kind of intermediate pullback, right? I still think we're closer to the beginnings of a long-term run than we are to the end of one. Even again, if I extend this out to 1 year chart, look how still 20% moves in gold and long-term bonds over the past year. So there's still, now that's gonna come down as we come off of this low point here, the 1224 low point that they had started. So they started the chart off pretty well there. But if I were just to customize this time frame and go off the 1224 low over there up until now, which is not quite a year to date, but it's off of that low point there, then you can kind of see, crude oil. I mean, this is the risk trade. It's crude oil and small cap stocks should lead the way higher, and they did there. But really, once we peaked, once that move peaked here, and really it was on would you say 5-3 from May the 3rd on. So right here, May the 3rd on till let's see, that would be of 2019. So basically over the last 6 months plus, 6 months plus, then there's your safety trade. Really take off 20% from that point, and everything else really lagging. These emerging markets still down from May, crude oil still down from May, and small cap stocks are flat since that May peak, whereas large cap stocks are up 6.5%, and real estate's still up, and those are still up double digits. So you see, yes, the safety trade is peaked, and yes, we've got a nice little run on large cap stocks and international stocks, but we really haven't got the broad participation in the total risk trade across the different asset classes. If we take a look at the calendar, you can see the biggest news today, we had existing home sales. They also had the Philly Fed survey come out and hit 10.4. Here's the chart for it, and you can see again, a lot of these indicators kind of peaked in this 2018 level. They've been coming down ever since. But you notice we're kind of getting some higher highs and higher lows developing on this. So it seems like things are starting to turn around. There's been a lot of chatter today about the leading indicators index from the conference board on a year-over-year basis falling below zero. Keep in mind that we've had a couple of those, the most recent one being coming out of 2016, and that led to a really decent run without dropping below. And you can see the things that kind of drove these pullbacks on the year-over-year level that got towards zero. And in fact, one other chart I mentioned, I replied to it here on Twitter, was, let's see here, this one, no, not that one. Well, actually, this was one of them. The last time we these are all the negative ones, and this gets a lot of chatter because the last two times it went negative, it preceded recessions. But this time here in January '96, it didn't. It only was negative briefly, and it turned around. And in fact, that was a mid-cycle adjustment where the Fed cut rates for three periods before the stopping. And the market took off. A very similar environment to what we're getting right now. In fact, during that time too, like we had earlier last year or this year, there was a wide gap, a tremendous gap between the U.S. Treasury yield, as low as it's been, and the German Bund, the 10-year. And so we had that now, just like we did here in this time frame. So we have a very, very similar environment to this, but you'll hear a lot of chatter because the last two times it went negative. Because see, these two times it didn't quite go negative. But the last two times it did led to some big declines. And if you look at the financial stress index, the last two times that it went negative, the financial stress index on St. Louis Fed, which has just been updated today too, was a lot higher going into that 2000 level. And it was even higher going into 2007. The market peaked in October 2007. So look at the financial stress in September, a month before the market peaked in October, and then we rallied. So we're not anywhere close to a similar stress level in the economy here, in the financial sector in particular, that would lead us to expectations that we'll get these kinds of moves in the year over year. More than likely, we'll get this kind of move like we had in 96, or these last two moves where we got close to zero and rallied up. And look at, even after here in 90, kind of 98, 99, we also dropped towards zero and bounced. So that's not even, I mean, it's very similar again to what we had. So just because we're close to zero doesn't mean we have to have these big 50% drawdowns and have recessions. Now let's take a look at how the sectors are performing. And if you take a look here, you see energy has really kind of had a good couple of days. If I were to go to the sector comparison tool and just kind of look over, like, say, this past 5-day window, the past week. So let's go to November, and then right here, and we'll go to a 10-minute chart. Look at the move. There's healthcare has been doing really well, and that's really benefited some of the trades in our class portfolios. But look at energy. Energy was way down, 2.5% decline in those first 3 days here. But in the last 2 days, we've gone from a 2.5% decline to a 0.6. There's no other sectors had that significant of a move. So here, let's just look at the last 2 days and show you what that looks like here. Health, you could say healthcare has been the only one similar, but it started off strong. See, we had, it's actually the 20th here. I've got 3 days in here. I need 2 days. Here's the 2-day window right there. There we go. Look at energy up 2.5% in the 2 days. The only other sectors that's even positive are healthcare and utilities. The rest of the market's been down this 0.5% pullback. And you see at the very bottom, real estate, technology, which has been a winner, materials. So, I mean, it's been a risk-off move. We just haven't had very much of an exhale. And energy hasn't participated in the rally, and it's kind of helping keep us from having more of a drop in the broader market as a whole. Energy and healthcare, it holding up, has kind of helped stave off more of a drawdown in these areas. When you look at the 12 grid for it, there's energy. I mean, energy is right there. So energy, I mean, that's a nice little pickup. It's kind of a little bit of a breakout move of a downward trend line that we have. That might start us on a little bit. I mean, it's got some catch up to do. Materials has pulled back. Everything is pretty pulled back. Discretionary has been the weakest one out of these cyclical areas. It's been unable to really get going. Financials has flattened. That's its pullback. Same pretty much for industrials too. Materials pulling down more. Look at real estate hitting resistance and rolling over sharply. Utilities also up against resistance level there. Those are the safety trades. So that's why I think safety trades still got some unwinding left to do. Staples also relatively weak. And then healthcare with its second overbought cluster of this rally, joining technology with those two overbought clusters. Very strong moves. So it's kind of, like I said, energy the last couple of days and healthcare's rally the past week has really kind of helped keep us up without, and as well as the sideways action here in financial industrials has helped keep us up without more of a drawdown that we would expect to see. All right, now let's take a look at our trade idea of the day, and I want to take a look at Las Vegas Sands. Las Vegas Sands is well above its Ichimoku clouds. Had a nice, good run. It's pulled back 38% of that move, a little bit below its Ichimoku of that blue line. That's potentially a bullish pattern. If you look at the market forecast here for Las Vegas Sands, you'll see that it's got the light pink shading in the yellow line. If you look at its 3 green arrow chart, it's got 3 red arrows, right? They're getting the 3rd red arrow today. When you trend trade stocks, when we teach you trend trading, we teach you to move up your stop order on a day like today, because either it's going to continue to drop and you get stopped out, or more often than not in bullish moves, it bounces off of this and moves higher and makes another run, another leg higher off of these lows. So considering also the Ichimoku cloud, and you also look at the Bollinger Bands here, where you can see that it's pulled down to this layer of volume support. It doesn't have a lot of downside left because of all the support below it, and easy move back up to the upside with less volume up above. So the path of least resistance is now back to the upside because of how much we pull down towards support. So that gives an opportunity for one of those, good risk reward trades where if it either bounces or it doesn't. And if it bounces, we have a good move higher, potentially up towards 65 on the December expiration, or higher than that by January, up to 66.7. It either bounces up into that area or gets there quicker, or it drops, and it drops below support and really falls. So that sets us up for, and if you look at the long-term view of Las Vegas Sands, it just recently got a golden cross, and then now we're retesting the 200-day moving average, which is very, very typical for after golden crosses to get a retest and then a continuation move. You can see in this direction here, you got the pullback there, but you get a move up higher off the golden cross, and you typically get a little bit of a retest. In this case, to the 50-day moving average, and then it continued higher. So that's kind of where we're at right now. We're in the retest mode. So either we bounce and continue higher, and we have good reward potential, or we go down. And I can keep my losses really small because we are already down. We're already we're already down to this. Excuse me. Let's bring in Las Vegas Sands again. We're already down to that point, right? So it's not like we're at elevated levels where my stop order would be down here and we can fall all the way there. No, my stop order is going to be right below this low point. And so in this particular case, to get a good reward to risk ratio, we looked at selling the 65 call option and buying the 62.5. So what that does here is because we already did this in the Market Outlook Live today, but when you buy the 62.5 and then offset that cost with this selling the 65, then here's the trade and what it does for you. For $67 of risk, which we only put half of that, we'll get stopped out at half of that, at 30 some odd dollars there. We get potentially $183 of reward. So a good, more than 5-to-1 reward to risk ratio. It's perfect if it gets above 65 and stays above 65. And it goes down, then we'll lose, we'll lose $30. And the nice thing is earnings per spread, $30 per spread. The nice thing is earnings isn't until after January. It's actually the day after expiration, early that next week. So we don't have to worry about it. We can position size up to a full position size, knowing that we don't have that risk of earnings that can impact things. So there's our trade idea of the day. All right, well, that wraps us up. You've heard from me now. Now I want to hear from you. Use that link right there, popping out in the top right corner of your screen. That takes you to our Market Outlook forum on our website at marketscholars.com. And let's keep the conversation going with our community. Open up any new thread or reply to anybody else's thread and ask with whatever questions or comments that you have about anything we discussed in the video tonight or anything we didn't discuss that you want to get a conversation going in our community about. As always, thank you very much for watching our videos. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow me on Twitter for more content, and join our community at marketscholars.com as well as the Facebook group that we've created. As always, thank you very much for coming or watching. Have a great rest of your Thursday night, everybody. We'll see you all tomorrow.